welcome back to our discussion on the accounting issues under the IFRS. We saw the plant, property and equipments, we saw the inventory valuation, we saw the cash flows. One of the issues which affects all these items as well as most of the items that a business entity gets into, if at all they have a foreign exchange exposures or a foreign currency based transaction, is IAS 21. IAS 21 talks about the effects of the changes in a foreign currency transactions. But in this case, I am just concentrating only on a foreign currency transaction, not about foreign currency or foreign operations. I am dividing that into two parts. My focus here is only the transactions or foreign currency transaction, not foreign currency based operation or a foreign operations. The objective of the accounting standard is a recognition of the foreign currency transaction. How will the currency transactions will be recorded? That is initial recognition. Then the translation of the statements into the presentation currency, which is we are not discussing in this session, and the treatment of the changes in the exchange rates. So the focus is recognition of the foreign currency transaction and the effect of the changes on those transactions due to the currency fluctuation. Translation, we will discuss it later. But to understand that, there are some specific terms like functional currency. Functional currency is a currency of the primary economic environment in which entity operates. In principle, a Singapore based company, maybe Sing dollar is a functional currency. An Indian based company, Indian rupees may be a functional currency. In some exceptional cases, the functional currency may be different from local currency, which we will see a bit later. The foreign currency is any currency other than the functional currency becomes a foreign currency. So if a Singapore company borrows money from US bank in dollars, then the dollar is a foreign currency. So conversion of dollar into Singapore dollar is an important one. The spot exchange rate is the exchange rate for immediate delivery or on the date of the transaction. An exchange difference is the difference between the currency values on two different dates. So we are going to use the functional currency, we are going to use foreign currency, we are going to use spot exchange rate and exchange differences in this presentation. The initial recognition, any initial recognition of any transaction denominated in a foreign currency will be recorded on the date of transaction by applying the spot rate as on the date of the transaction. Sometime you can also use averages of maybe last 3-4 days or last week if you think that average reflects the actual and determination of actual is not possible. Initial recognition, let us take an example. If A Limited, a Singapore based company, borrows from an American bank a loan of 10,000 USDs on 27 December, and on that day if this is the exchange rate, then the balance sheet will record the loan and the corresponding value of the asset, that is cash, at the rate of this rate of currency conversion, which amounts to 13,010 Singapore dollars, 13,010 Singapore dollars. Then subsequent recognition. But for subsequent recognition, one has to classify the items into monetary items and non-monetary items. Monetary items are like receivables, payables, loans, bonds. These are all monetary items. Whereas a non-monetary item other than these items are called non-monetary. Plant, building, equipments are non-monetary. So subsequent recognition of a monetary item should be on the date of the closing rate on the date of preparation of the balance sheet. Whereas for a non-monetary item, it is at the rate prevailing on the date of the transaction. But sometime non-monetary item like plant, property and equipment, as per the respective accounting standard, maybe you might have done some revaluation. In that case, the date on which you have done the revaluation, the exchange rate on the date of revaluation should be used. In other words, let me summarize. For subsequent recognition depends on the type of the item. A monetary item, or a non-monetary item. A monetary item should be valued or revalued on the date of, at the rate of the closing rate, and a non-monetary item generally, if it is not revalued, as the date of the transaction, and for a non-monetary which is revalued as on the date of the revaluation. As a result, initial recognition, subsequent recognition, if the rates are different, there has to be some difference in the form of a gain or a loss. The accounting standard says that gain or a loss should be recognized as a profit or loss in the income statement. In the income statement. Let us go back to the same example. We have taken the loan. The exchange rate on that day was 0.7686 USD, but on 31st 12, that is 31st December, it is 0.07797. Exchange rates are different. So as a result, the loan, which is a monetary item, will be revalued as on the closing date. So the loan will be now 12,825. If you observe, the previous loan was 13,010, whereas now the loan value is different. The difference in the loan, that is a monetary item, is arising due to the currency fluctuation. And this currency fluctuation, which is the loss in this case or a profit in this case, will be shown in the income statement. So this profit in this case, because the loans have reduced, and that gain will be shown in the income statement. And in this example, I have assumed no other expenses, no other income. My assumption is only profit or only income is the currency fluctuation, 185 Singapore dollars. As a result, that is overall profits for that period, and that profit will be shown in the balance sheet at the end like any other profit. So subsequent recognition results in fall in the value of the loan. As a result, there is a profit through the income statement to the balance sheet. Summary. Initial recognition convert the foreign transactions at the spot rate. The subsequent recognition for the monetary item at a closing rate, for a non-monetary item on the date of transaction, with an exception of those items which are shown at the fair value, the revaluation date, and the gains and losses should be shown in the income statement. That is IAS 21. As I mentioned in the beginning, in the next discussion, we will focus attention on those operations or those companies which have a foreign operation. Then you have a translation gains or translation losses. Thank you very much.